Joshua Hayes at bigwavetrading.com. I've been warning everyone about the potential for a market sell-off for quite a while, but this market has just been resilient, broke out to new highs, SPY, but now a complete rollover, breaking down below this, what was a downtrend line previous breakout on heavier volume. Yes, it's still above the 50 SMA, but as I'll review with our tickets indicator at the end of the video lesson, we've been warned ever since this control candle here. The tickets indicator has remained below the zero line the entire time on all four of the majors. And now with this rollover in the SPY, you can see all of the distribution days leading up into this rollover. I definitely think it's time for risk off. The QQQ, similar situation. A lot of volume on today's fake out breakout. And as I'm also going to show you, there's another indicator called the TTM squeeze. And we were in a squeeze. We started to break out higher. You're supposed to resolve out of that squeeze into what we call green dots and then trend higher. The worst thing that can happen is to reverse that signal back into the consolidation levels with that squeeze still being intact. So if you look at the QQQ SPY, doesn't look that bad, but when you look at the IWM cracking below the 200, at least it's uptrending, again on that heavier volume, the relative strength line paints a more grim picture for this index. The DIA breaking below that 50, so much for that cup with handle that was forming. Improper, if you ask me. Double bottom, it's all wrong. Symmetry wise, it was just all wrong. But benefit of the doubt always goes to price until it doesn't. And now we have the DIA rolling over. I've warned about the 1 year moving average of the put call ratio being at extreme complacency levels. I've been warning about this VIX. Despite this market moving to new highs, the VIX continues to build higher lows. We now appear to be breaking out on the upside. I've been warning that defensive sectors have been outpacing leading sectors, like look at XLC, XLK today, and look at XLP. I've been warning about the lack of new long signals, and I've been warning about the second half of February being bearish seasonality. How bearish the seasonality is always pretty poor, especially in the last week of February. So everything appears to be lining up. And lately, I've only received one long signal recently on the quality side, and that was AXS yesterday. No trigger, no fill. The trade is still good to go until we close above the high or move past the high of the day, moving up and through that level. But you'll see it's an insurance stock. Well, here's the other stocks I flagged today after I ran my scans. WTW, insurance stock. BRO, insurance stock. WRB, insurance stock. You getting the hint? So we have defensive sectors outperforming the aggressive sectors. Insurance stocks are dominating my scan. New long positions have been few and far between on the swing position side. It's about as risk off as it gets. So that's just looking at that. At my telechart version 7, there are no new long signals this evening. Now we're moving over to telechart version 25. You can see now with the horizontal line, breakout, fake out, we're back below the 21 EMA on heavy volume. You can see we were in a squeeze, a medium squeeze, a good squeeze. We broke out. We have now faked out. We're still in that squeeze, resolving lower. That's normally not a good thing. So that's what I'm talking about with the squeeze. The QQQ, similar situation. If we just make this a horizontal line, you can see an attempted breakout, fake out, also in a squeeze, went from gray dots to red dots, back down to gray dots, should be resolving higher into green dots. Squeeze. Oh, we went gray for 1 day here. We ended up rolling over a little bit, but then once the green dots returned, we were back higher. Anything can happen in an algorithm regime. Normally, before algorithms made up 90% of the stock market trades in the overall market, this kind of setup would actually lead to a decent pullback that could last from 1 to 3 months. In today's market, you can have a bullish reversal hammer candle, undercut and rally candle, and then ramp back to new highs due to the way that the market works nowadays. So being 100% sure that it's time to pull back, whatever. It may or may not happen, but right now it's a full-on defensive look in this market. I reduced size per the anti-martingale methodology the session before. I'm doing it again today due to the overall market environment. And of course, the recent long positions aren't performing that well. But that being said, most of the ones that we've taken lately are still holding up and or have not failed completely, but they're not running. And another thing that's happened lately, you'll see over here, I have a tight squeeze scan. There's only 2 stocks in the daily, only 9 stocks in the weekly one. And on the daily one, if you look, NTRB is nowhere near the proper setup that I like to see. LPLA is extended, but there were 3 stocks setting up in pretty good setups. All 3 have rolled over. UAMY, rollover. ECOR, starting to roll over, has at least failed the breakout attempt. And then ACHR was the best one. Now, off the 21 EMA, they did produce gains, but they're failing their breakouts and are re-rolling over. So there's just multiple signs that it's a defensive posture market. Definitely going on the defense here after Friday's session. And then we'll end this video lesson off with just a look at all the indices. Actually, we can just go ahead and just show you really quick before we look at these. Another development, ARC has rolled over below all of these moving averages, 21 and 50 SMA on heavier volume. That's another ugly breakout, fake out, but even worse is the IBD 50. This is a really ugly breakout, fake out, rolling over. And while these indices look the best, the most important thing, we always say at big weight trading, when price is above the 50 SMA, this indicator should not be the zero line, or else the chances of something failing is quite high. Now, if we test the 50 SMA, start to consolidate, get back above the zero line, as you see here, good things can happen. Even on this pullback here, we barely got below the zero line, and then back above the zero line and off to the races. Once we had this gap up, it moved this indicator above the zero line, and then things went pretty well until that control candle day. A few sessions later, back below the zero line on SPY. We have not reclaimed it this entire, basically this year, this entire year, we've never reclaimed the zero line. The QQQ, similar situation. A little bit better than the others because we're kind of riding the zero line, but we still have never reclaimed it with gusto, with emphasis. It's just very weak. And the DIA, despite being the strongest looking of all the indices, never got above that zero line. The IWM obviously is nowhere close and looks the worst out of all of them. So it's definitely a risk-off market environment. Longs were already hinting to us that something was happening before this happened. But in the new algorithm regime, you can't really just assume that even though everything's lining up, we're going to roll over. You have to wait till price confirms. Well, price is confirming now. So risk-off environment. This too shall pass, just like it always does. And if we keep selling off, I'll go to work in the long-term portfolio. I'm looking to buy leading stocks. You guys know my forever holds. On any pullback below the 200 SMA, 500 EMA, the same situation involves the QQQ and the SPY. Give me any kind of undercut and reclaim of the 200 SMA or the 500 EMA not shown on this chart with the trend lines moving higher. I buy every reclaim all in with whatever cash is available in the long-term accounts. We'll see how this market shakes out, I should say. But I think we at least have a week minimum of poor price action in the cards.